The fact of the matter is that you can add one step to what it is that you're already doing in life, business, or investing, and you can own and be profitable for the financing of what it is that you're already doing. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. We're back for another installment in our book review series on the book Becoming Your Own Banker by R. Nelson Nash. It's great to be back in this particular series. This is a very exciting part of the book. We're going to be covering pages 51 through 64. This section of the book, this chapter of the book, is part 4. The chapter is equipment financing. So this is where the rubber can meet the road for everyone. There are so many examples that we could use. The one that Nelson uses is one that he was very familiar with, being in the forestry industry, like we've already covered. Understanding what he did about banking, he just connected those two dots, and here we have equipment finance. Now, let's start with some highlights. An IBC policy, an IBC style policy, infinite banking concept style policy, is the ideal asset for a private banking entity. We've already established that. Now you can incorporate this process with what it is that you're already doing in life, your normal business. Of course, this could just simply be your household, but we're going to talk about something in this example that's outside of the household, but it could be household, it could be business, it could be investing. But whatever it happens to be, these principles are going to apply. Okay, this process is going to apply. In fact, when I was preparing my notes for this particular episode of the book review, I thought about having recently called out a land surveyor to come and survey some property for me. And I met him at the property, and I see the back of the truck and the tools and the equipment that's there. And there was just one box in our conversation that he ended up pointing out in particular, and he told me how many tens of thousands of dollars worth that one little box. I mean, it wasn't so very much bigger than an old school lunch box, okay? And he was telling me how many tens of thousands of dollars it was and how much more it would even cost to replace now, okay? And that was very relevant for his business. I saw him pull this equipment out and use this equipment. Okay, so one way or another, in my mind, of course, I recognize that he financed that. He either bit the bullet, paid cash for it, or it was something that he made payments for, a debt that he assumed. But that's just real life for all of us. So whatever it is that you're already doing, okay, implementing this process with these principles that we've already covered in these prior chapters on the human issues, etc., okay, the principles of implementing the infinite banking concept, they all come to bear with something like financing equipment. And as you begin to do that, and here's something that I love, that Nash puts the impetus back on the individual, back on the banker, right? He says, you should pick an appropriate plan for you. And I have conversations with folks all the time, and we will get to their particular questions, but there are many recurring questions that I will get, and some of those may be around premium, and some of those may be around company, and some of those may be around the structure of a policy. And I love that, and that's why we're doing this series, of course, just to have a conversation. You know, what I do here on this series, this is not a replacement for you actually rereading the book. In fact, I can go ahead and tell you that while I've been doing my rereading, and this isn't the first, this isn't the second, this isn't the third. Okay, I've read this book many times, but every time I get to this book, I carry something new. In fact, when I was writing the notes for this episode, I work from an outline. I'm a note taker. I saw something that I understood, and yet how Nelson had worded it struck me in a brand new way. So I'm not saying that I didn't recognize that principle already from one of my prior readings, because I have read this book several times, and yet it struck me as like new, and I felt like I understood that particular concept in a new way. So I'm encouraging you, of course, to get back in his book. Of course, he's got his second book, Building Your Warehouse of Wealth. If you've never seen his live seminar, there's a recorded version of the seminar that he used to give, several hours of his original content. That's my greatest encouragement to you, because And again, we've already covered this philosophy of when you know what's going on, you'll know what to do. So Nash put the impetus back on you. I will put the impetus back on clients and prospective clients. I love his philosophy of traditionally answering a question with a question. He would say it's biblical to do so, and I find that to be true. So I will do that, not because I'm hesitant to give a straightforward and a frank answer, but rather to promote thought for you to arrive at knowing what is appropriate for you. So with that being said, Nash says in this particular part of the book, Equipment Finance, that you should be picking and selecting an appropriate plan for yourself. And then, of course, it's time to capitalize that plan. No hesitation, no complaining. We must recognize that every dollar that we pay in premiums is capital into this private banking system, wherein we can finance equipment. For example, whether we're a land surveyor or whether we're in the logging business, the tree industry, like the example from his book, we can't hesitate. And that's one of his key principles. That's number 2. Okay, number 1 was think long range. Number 2 is don't be afraid to capitalize. So we need to capitalize this system. Nobody's ever had too much capital. Nobody's ever had too much access to capital. So I believe that when you understand this, I know for me, what I was going to say is when you understand this, you will want to pay premiums. What I know is that's an exciting time for me. I look forward to every single premium payment that I make into our several policies that we own. At the time of this recording, 2023, we own several policies. And I look forward to maxing those premiums out, getting as many dollars as I can, getting as much capital as I can into our system. So we need to adopt that mindset. Premiums equal capital in our system, because he does encourage us to look at becoming your own banker as a business, have a business mindset, and look at every policy that we open as a brand new branch of that business. So when we open up that branch, which is so neat, it's already pre-engineered. We've already got the hired help, as he called it. We've already got this insurance company, whichever company it is, and there are several great ones that have been around for over 100 years, that have paid dividends consecutively for each of those years, that are really rock solid financial institutions, the best, I believe, in the world. And we just have the benefit of all of those resources, of all of that background, of all of that history, of that hired help, those administrators, those facilitators of this private asset that we own. It's a beautiful thing. It's a beautiful thing. He says, you don't have to get any licenses. You don't have to seek out customers. It's like, well, we're already the customer. We're becoming our own banker. And then, of course, that can spread. You can segue right into family banking, and then there are business implications, which again we're going to get to the further that we dive into this equipment financing part of the book. So he does give us this example of a 30-year-old man, and I'm going to point out some particulars here, okay? Because again, every week I'm on the phone with folks and we're talking through their particulars, their dreams, their goals, their plans, their current financial footprint. What does that look like in its totality? So we can have a comprehensive conversation about moving forward, about implementing the infinite banking concept. And again, I've already said and pointed out where Nash says that we should be selecting an appropriate plan for ourselves. So when I get into these details, and I'm not going to be putting up screenshots. I'm not going to be putting up charts of his illustrations. And here's why, before we start talking about these concepts, because I do want to focus on the concepts, not so much on the details. Nash was asked after the book had already been released about the book, and this copy that I have right here, it's the 5th edition, right? Because certain things changed, not his principles, not his philosophies, not this new paradigm of financial independence. No. But because he did include things like tables and charts, illustrations, he later said that if he were to redo the book, he would not include any illustrations. And here, let me reemphasize a quote that I enjoy and use very much and appreciate from James Nethery, when he says, "When you understand the concepts, the details don't matter. When you don't understand the concepts, the details don't matter. Okay, so my belief, my approach is that when you understand the concepts, the philosophies, the details don't matter. That's not to say that we won't get to numbers. That's not to say that numbers are unimportant, but they have their place after the concepts. If you can wrap your mind around the very idea that you can become your own banker, that you could capitalize a private banking entity and even expand that into a private banking system of these self-collateralizing, appreciating assets with all these ideal characteristics, the details don't matter. Okay, so 30-year-old man is the example. This particular policy was a paid up at 65 policy. Now, even in whole life insurance, there are several types of whole life insurance. And this is not to be too extensive, but it paid up at 65 and paid up at 70. You could also have 10 pay policies, 20 pay policies where you pay level premiums for 10 years, 20 years. Okay. You could have policies that are 100-year policies, 121-year policies. I own several 121-year policies because my philosophy is that I want to have the ability, the contractual right, to pay as much premium as possible for my whole life. Okay. Now, again, I don't have a cookie cutter approach in mentoring folks and coaching folks and writing policies for my clients. Everybody should be able to select an appropriate plan for themselves. But this example paid up at 65. So I'm just pointing that out because you should know why you're picking the product that you are. Okay. And then once you have that product, of course, as you can see in his illustration, there are splits in this policy. So anytime that you hear this reference of splits, it's referring to the amount of your premium, the percentage, let's say, of your premium that goes towards the base whole life policy itself. And then, of course, for an IBC style policy, we are going to attach a paid up additions rider onto the whole life policy. So let's say a percentage of your total premium is going towards the base whole policy, and the other percentage is going towards the paid up additions rider. And there may be other riders. There may be a term rider. That's not always appropriate. Again, you should know what's appropriate for you. It depends on what you want across the board, the amount of death benefit that you need out of the bat, the liquidity that you need to have access to, your long range plans, so much. It's a comprehensive conversation, more than one conversation, actually. And at least it is with me. And that is why it is so important for you to be working with somebody that you're not trying to educate on this subject, but that has implemented this practice into their own life and are helping other people do the exact same thing. So that's splits. It's referenced right here in this information. Again, I'm just trying to cover the concepts here. That's a concept with a properly structured whole life policy, that a percentage of your premium will go to the base whole life policy itself, and another percentage, normally a goodly sized percentage, okay, so that you can have immediate access, first year access to capital for what it is that you're going to do, like financing equipment. Okay, so you're going to have a paid up additions rider. You may have a term rider. There may be other riders, okay, that are important, especially for your long range goals and plans. So that splits. Cash value. Here's something else that's mentioned as you read and you look through the narrative in part 4, and also as you look through the illustrations that are included in the book, is you're going to, and Nash will point these points out, where the cumulative outlay is met, and then the policy essentially is dollar for dollar. Okay, so the amount of cash value that you have accessible is equal to the premiums that you've paid. And then, of course, thereafter, that means that policy is going to be that much more efficient because it's producing more in cash value than you've even paid in premiums. So when your cash value equals your cumulative outlay is going to depend on the structure of the policy. And again, this is something that should be part of your conversation, whether this is your first policy, whether this is an additional policy where you're already adding to your system. This should be part of your conversation with whoever you're working with. And of course, in this microwave mentality society that we live in, I mean, that's just a human nature problem. Okay. Really, it could go all the way back to Parkinson's. And it can certainly go back to, and that's why Nash repeats it so much in this particular part of the book, not being hesitant to capitalize, not complaining about capitalizing your system. Folks that are trying to get to 100% of their cash value in year 1, in year 2, in year 3, they're not understanding the lifelong implications of this process. And so there's that, the understanding of the process. But also when it comes to the product, if you've had a product that was poorly designed to provide too much, and I know that could sound contrary, think about this, but one that can have too much liquidity in the short term, but exposes itself to risk in the long term. Here, when I showed up, I wanted to have this policy, okay, this first policy. If I go back to 2016, when that first policy went in force for me, I anticipated owning that for my whole life. Today, it's my favorite policy simply because it's the oldest. It's not the biggest. It's not the largest. Okay. But it's my favorite just because I had it first. Okay. It's so very efficient now after having owned it and used it and capitalized that policy for several years. And it was built from the start to be able to use and own and operate for my whole lifetime. So I'm just trying to give a word of caution of trying to go on dollar for dollar too soon. It's important that your policy be built with an absolute solid base. And I'm using that word particularly. Base meaning base premium. The base premium of your policy should still be a significant portion of your total premiums. Okay, to avoid potential risk in the future. So, in this example, Nash actually shows no further premiums after 4 years. Now, this is really interesting. Again, the structure of the policy matters. Your plans matter. Okay, Nash shows some really neat concepts to us by doing something like only showing premium payments for 4 years. Now, I've owned a policy, like I've already said, for several years longer than 4. Better part of a decade now, actually. And I do not foresee a time on the horizon yet. The time may come. And there's a big point, because it's nice to have options. It's nice to know that a policy can get to a point where its growth is creating more than dollar on dollar, where its dividend could be paying for the ongoing premium, where I may not fully fund my paid up additions rider and just cover the base premium. I mean, so many different options. And isn't that the point in becoming your own banker, that you maintain the control? It's a beautiful thing. But he shows here 4 years of premium, whereas I'm thinking, when am I ever going to want to put capital into a policy or a system of policies that are going to do what these policies do? Especially when we use them this way. I'm never going to want to quit. I want to get as many dollars as I can my whole lifetime, and I want to see that perpetuated to the future generations for legacy purposes. But neat to see that this policy was funded for 4 years, and then because of how it was used after that, and that's the point here. That's the point, is did it have to be, okay, from this individual's cash flows, did it have to be funded from his cash flows for more than 4 years? No, not necessarily, depending on what he did with the capital that was accessible. See, when you do something like start recapturing interest dollars that had otherwise been going to other people, you're so much more profitable. You have so much more capital that is returning to you just from what you were already doing anyway, that you have at your disposal to work with. It's an incredible concept. And again, when you go through these several pages, because there are several pages in this section, study these illustrations. Study them. Look at the fine print. Consider the nature. Consider the rights. Consider the structure. Consider the possibilities, okay, of what you're seeing there. Just my encouragement is don't get bogged down in the numbers, but see instead, yes, the nature, the contractual rights that you maintain as the policy owner, etc., over getting bogged down in the numbers, because this book was written decades ago now at this point, and Nash had already implemented the infinite banking concept decades prior to writing this book. So the principles permeate through time. Okay, the golden rule: he who has the gold makes the rules. That just permeates through time. Doesn't matter which decade we're in, right? Not hesitating to capitalize our own system. That principle permeates through time. So dividend scales might change. Markets, they certainly go up and down. Learn as much as you can there too. And I love that Nash has his suggested reading section in the back of the book. I've made it a purpose of mine to keep chipping away at that massive list, because I do think that's interesting. I think it's interesting to be able to see the things that Nelson enjoyed reading about, dedicated himself to learning, thoughts and ideas and literature that he was exposed to that helped him arrive where he did to be able to write his own book for us. I'm so very grateful and thankful, and that's intriguing to me. So I've made an effort of going through different things that Nelson encouraged us to, whether it was The Law by Frederick Bastiat and several others, right? Several others. So as you're making your way through here, focus on the nature of the policy. He will eventually talk about surrendering dividends, for example. Now, do you have to surrender dividends? No. Does he in his example? Yes. And there are several dividend options that a policy owner has. You could, and here's what I most often encourage folks, of course, and Nash does too. He actually talks about a policy that he owned for, I believe it was 15 years, and he did not have the dividend by paid up additional insurance in that policy. And he regrets it, of course. He didn't know what he didn't know at that time. And what he did was he just had that dividend reduce his premium amount. Okay. So when he was awarded a dividend, which he was with a mutual company, he had that reduce his annual premium that year. So that's an option that you have. And again, isn't it nice to have options? But of course, primarily we will choose to use our dividends to buy paid up additional insurance, because all that does is increase the death benefit. And because the death benefit increases, inherently the cash value must also increase. So the death benefit can just keep going up on policies that have been structured this way with these types of companies. And the cash value just keeps going up. And then that's the pool of capital that you're using for what it is that you're doing in the wide world. So you just can have this constantly compounding pool of capital. Amazing. And there are other options. You can just get a check in the mail. Okay, so there are several things that you can do with your dividend. Here, of course, he illustrated that you could surrender dividends that you'd already been awarded, to be able to make this policy self-sufficient, okay, to cover the base premiums, etc. Now, the death benefit, let me go to that particular point here. The death benefit of a policy matters. Now, certainly, Nash has to say it so many times that we focus on the cash value and building a high cash value in the policy and minimizing the death benefit. Because traditionally, of course, someone goes into a box store, talks to a box store agent, asks for the smallest amount of premium that they can pay for the largest amount of death benefit that they want. And there you go. That's the traditional plain Jane vanilla approach to whole life insurance, right? Is that you pay as little as possible to get as much as possible. There you go. It's all about the death benefit. Whereas we're building policies for a high cash value where we can use this asset for the banking purpose. Completely different paradigm. So that's not to say, however, that you disregard, that you should disparage the death benefit. I believe this is my philosophy, and this is what I have gotten from R. Nelson Nash, is that somebody should be adequately protected from the start. If you have responsibilities, if you have obligations, if you have liabilities that you should cover in the event of your untimely demise, unexpected, now we're all going to pass. And that's one of the big reasons of having whole life insurance, is that it's something that you can own for your whole life. And while those premiums are paid that you've chosen to pay, your beneficiaries will receive a tax-free windfall of capital. Okay, that will happen. We're all going to graduate, as Nelson would say. Whole life policies accommodate for that. Transfer of wealth to the next generation. But from the start, everyone should have an adequate amount of death benefit. So again, here, this is where I mentioned a little bit earlier about term policies. It may be the case that you have a properly structured banking style policy built, and you have a term rider added onto that policy. That may be the case. That may be the appropriate plan for you. It may be the appropriate plan for you that you procure your IBC style policy and an additional standalone convertible term policy. And you can do that with great mutual companies where you have your banking style policy, you're out there financing equipment or whatever it is that you're doing, but you also went ahead because you were younger, you were healthier, just because you could and maybe should, okay, get a certain amount of death benefit in force, but you want the opportunity to be able to convert that term policy into a whole life policy later on in life. You want to have that contractual right to be able to convert it. You're paying lower premiums now on the term policy, but it's a convertible term that you'll be able to convert into a whole life policy later on. So that could just be another policy in your system of policies over the course of your lifetime. I wished I'd caught on to that idea, in fact, sooner than I did, but it's a very useful approach. So all that to say, from the start, I believe that everyone should have an appropriate amount of death benefit, and a policy with an appropriate amount of death benefit can still have all of the ability for you to be able to begin becoming your own banker with that policy also. And in fact, remember, Nash would say that these types of policies, when you're using them, these whole life policies, can grow a death benefit so significant that actually at the time of your underwriting, you would have not been able to obtain that amount of death benefit because of how you use the policy. And of course, how you use the policy is going to be a recurring theme here. Now, capital accumulation is another topic that we come across. Capital accumulation in a policy, it's important to know, is tax deferred. Tax deferred. Okay, so the growth is tax deferred. Now, the access that you have to capital during your lifetime via policy loans is tax-free. Tax-free. The access that you have to cash values via withdrawals up to the cost basis, tax-free. Of course, when you pass, your beneficiaries will receive the death benefit tax-free. Okay, so I try to say that very particularly to let you know that the growth in a policy is tax deferred. And yet, what you in practice have is tax-free access to withdrawals from the cash value up to your cost basis, tax-free access to policy loans your whole life. While there's cash value, you can make policy loans tax-free. And then, of course, the death benefit is going to be an eventual tax-free windfall to the next generation. So when it comes to noticing the mention of capital accumulation in this section, that's very important to remember. Continuing on in his scenario, Nash gets to where this gentleman is age 66. He's expecting to receive passive income at this point in life. And there's some really neat things, okay? In this particular part of his scenario, we're still all on page 51, I believe, in that he's just describing this man owning a policy. We have not even yet got to equipment finance. This is just him owning the policy as an individual, which is really neat. This isn't him branching out into multiple trucks and things like that. So at age 66, he could be receiving passive income, still maintain a capital base, okay? The death benefit has just gone up, of course, from the start. And again, all of this is just as an individual prior to financing any equipment. Now on page 52, when it does come time for financing equipment, this man is first in line. All right. So the insurance companies, they do certain things, a handful of things with capital, of course, to be able to meet their requirements of paying death benefit and such. But as the policy owner, this gentleman is first in line. He's not asking for permission. Okay. When you contact the insurance company, it's with a service form. They are there to serve you. Remember, the Gophers, the hired help, to use Nash's language. So what you notice beginning in page 52 is what's very common for lots of people now in the business world. Really, most businesses don't make it. I would ask, why is that? Why do you think that most businesses don't make it? Okay. And then let me clarify by mentioning that capital is very relevant in answering that question, I believe. Okay. Now you got to have good business plans, relationships, and leadership. All these, there are lots of factors, right? But it's hard for a business to run out of business while it has capital. Now, if it doesn't have capital, it could have the best leadership. It could have the best plans. It could have, okay. So you see what I'm saying there? So most businesses don't make it. In this example, let's table that for a moment, whether businesses make it or not. And let's just address that here's someone making a so-so income, okay? An average income, an all right income on their business, while the banks are making bank. Notice how I put in some verbiage there that might be common for lots of us to use. It's important to recognize words are powerful, okay? The bank is living very well off of this man's business. Aren't the banks living very well off of all of our businesses? Right. So this gentleman's first in line to bar against the policy. He has been building up equity in his equipment over the course of time, which conventionally speaking, all those professionals are going to say, well, that's great. Okay. But Nash points out that that's the wrong place to have equity being built up. Okay. It's not to say that having equity in equipment is bad or having equity in a home is bad, but what are the conditions of that equity? Is it readily accessible? Can you leverage it? Is it at risk? Does it account for inflation, litigation, taxation? I mean, lots of different things. Okay. It's just worth asking those types of questions about where equity is built up. Nash is saying that's the wrong place to have equity built up. And then he continues by saying that businesses come and go. Look at this. This man's making a so-so income. Banks are making bank. His business could be in that statistic of the vast majority, most businesses, the vast majority of businesses that don't make it. But banking will still exist. If he has a step of being in the banking business himself, how much more durable does that make his business? Number one. And even if that were to fail, he'd still be in the business of banking. So again, capital, having access to capital, very good scenario. So the example that he gives in the book, and this gave me thought. So he mentions Bill Gates, okay? How Bill Gates, 25 years prior to the time of him writing the book, his company didn't exist as the entity that it was at the time. He's richest man in America at the time, and his business didn't exist 25 years prior. Amazing. Businesses come and go, right? But amazing. And then I thought about one that's maybe more relevant for my time, and that would be Mark Zuckerberg with Facebook. I can remember being in college, and MySpace was the platform that folks were more familiar with. And then here comes Facebook, and now it's the global entity that it is. Just interesting. And there are lots of other examples, right? Like the Blockbusters of the world. Where are the Blockbusters at? Big business at the time, very well known, etc. But it came and went. But the banks that financed these different businesses that we're referencing, are they still around? That's worthy of note. So being in the business of financing your business, Nash points out, necessitates that you apply a market rate of interest to what it is that you're doing. A market rate of interest. That's very important. That additional interest, he goes on to say, is what's going to be additional premium into your paid up additions rider. So the paid up additions rider, we talked about splits earlier, the two main parts of a policy, the base policy, the whole life policy itself, plus a paid up additions rider. The paid up additions rider is the flexible part of a policy. And that's where you can accommodate the additional interest, the market rate of interest that you should be paying for the things that you're financing to the paid up additions rider. Now it has limits. You can max it out. And then of course, that's where Nash says that's when it may behoove you to add another branch to your system. You add another policy, okay, to your system to be able to accommodate the excess capital that you need to warehouse. So the additional interest by giving yourself a market rate of interest, okay, because maybe the company's only requiring you to pay a handful of points of interest, okay, but you're going to give a market rate, and it might be double that, it might be triple that, it might be, so many points above that, whatever the number is. Again, the concept versus the details. But he says, pay a market rate of interest. That additional capital is premium into your policy. And he gives a point here, which I appreciate as a professional. He does say, even though he's already told us from the start, this book's for the layman. It's not for the professionals. And yet he doesn't disregard here to mention that for folks working with individuals getting started or vetting this concept, he says, if there's hesitancy here, of course, he says, well, take them back to the grocery store example, take them back to the First Bank, Midland, Texas. Okay. Take them through these examples. And if they still won't or they refuse, okay, to do something like pay a market rate of interest to themselves, he says, be cautious and maybe even don't work with them, because either they are dishonest, okay, they're going to steal the peas, or they're just an unteachable person. And that speaks to his arrival syndrome that we've already covered as well. So that's his encouragement to agents, which I can appreciate and can even attest to. Thankfully, I get to work with lots of great people. But again, this is a new paradigm, and we have to push back former thinking. I've not arrived, okay? We have to agree that we've not arrived if we want to move forward. And that's what he says for agents right there. We must be encouraging honest banking, all while recognizing, and I'll say this for myself, I've made so many mistakes along the way. Having practiced personally the infinite banking concept for the better part of a decade, I've made all kinds of mistakes on the way. And I told you, I'm still learning from this book, even while I'm giving a book review for our channel and podcast, which is really neat. But I'm still on my way, folks, and I'm encouraging you to come with me. And of course you are. You're tuning into to a book review series, so of course you're on board for it. Now, a big takeaway from this page 52 is where he zeroes in, he hones in on how the policy owners' actions are what have created all of this growth, all of this prosperity, all of this profitability. It's the actions, okay, of the owner, not the policy itself. The policy's doing great things. No question about it. Compounding, giving us access and control. Sure. But it's the behavior, it's the action, it's the choices of this individual that are making all of the difference. And he does say you'll reach a limit with a particular policy. It'll be maxed out. Won't be able to fit any more capital in. Okay. And that's when it's time to expand the system. He does say get additional policies as soon as possible. I've found that to be true in my own life. When we got our first policy back in 2016, we had debts that we were conquering. We paid off tens of thousands of dollars worth of debt, but it wasn't 6-8 months along. And I'm not saying this is the case for everyone. It could be slower, could be faster, but we weren't 6 or 8 months along before we realized we need to get another one of these. And we got a policy on my wife as well that's even bigger than the first one was, because we had caught on to this idea a lot more, and we were ready and we wanted to go faster. And in fact, hey, checking another box, having one of these whole life policies on my wife provided the death benefit for the 2 adults in our family. There we were. We had our 2 boys at that time. Now we've got our girl as well. It made sense for all those reasons. We're paying off debt, recapturing interest dollars that otherwise have been going to other people. We were two grown adults with a expanding family. It made sense to have more protection than we did have prior. So we were trying to move all fronts forward. We wanted to get additional policies as soon as possible. I still don't have enough policies. I still don't, okay? I'm still on my way. And with the passing of time, I still feel more fervently about that. So start reasonably, start logically, just like we've talked about before. Start where it makes sense for you. Everybody can start, whether you're making $10 an hour or $10,000 an hour. It doesn't matter. Start where it's appropriate for you. And yet, when you're looking back, you're going to realize that you wish you'd have gone faster too. That's just going to be the case, and that's okay. But the owner in his behavior is actually making money, which is so neat. Okay. And again, this doesn't have to be fancy. This doesn't have to be complicated. You're already doing something in life, whether it's running your household. You already have a business that you own and operate. Doesn't matter if you're a sole proprietor. You got a crew that works for you. It doesn't matter. Okay. Big business and you're investing, whatever it is that you're already doing in life. If you add the step of financing that thing, you enjoy the profitability, the control, the ease of management of your financing. It's an incredible thing. Now, let's go to page 54, 55, 56, just to mention those are all illustrations and diagrams worth looking at. I mean, when Nash is talking about the gatekeeper, the toll taker, okay, in his diagram in these pages, who do you want controlling the banking function in your life? Do you want a gatekeeper in your life? Do you want a toll taker in your life? Okay. There's a better way. There's a different way. You can live and leave a lasting legacy by reacquiring the banking function in your life. So I'm not going to spend a lot of time there. Study those. If you have any questions, I'd love to have a conversation about it, but it's the concepts that matter. And then on 57, Nash paints the picture of how once this man scales his operation of banking to a certain level, he can even accommodate more than just the trucks, but rather the property and casualty that is necessary for such equipment, right? He can have the sufficient capital that would be required and the systems in place to go ahead and take care of more aspects of financing in his business. Okay, not just the vehicles themselves, but it could be anything. It could be the maintenance. It could be the replacements, of course. We've already been mapping that out. It could be the property and casualty expense. So many different things. So again, for you, think about your business. Think about the top, 1, 2, 3, 4, 5 expenses that you have in your business. And if you could pick one starting point and be your own banker on this thing in your business, okay? And then you grow that and you scale that and you grow that. And then you could accommodate another task, another sector of your financial footprint in the business, okay? And you begin to own that and you begin to retain interest dollars that had been going to other people. And you get that toll taker, you get that gatekeeper out of your life and you keep growing, expanding until you can do it all for yourself. That's possible. And that's what he describes here. And the beauty of private ownership, okay, in talking about toll takers and gatekeepers, the beauty of private ownership, I don't believe it can be overstated. I do not think so. At this point in this scenario, this gentleman in the logging business, what could he do? He could, with the private ownership of his policies, he could lease. This is what Nash describes. This is one option. He could lease his equipment to the corporation. Okay, so he's privately financed it. Could be. He could lease that to his corporation. And this probably is a good time for me to say, talk to all your relevant financial professionals. Okay, this is an advice. We're going through a book review. We're talking, having a conversation about becoming your own banker. So talk to all your relevant financial advisors, okay, and professionals. But he's got a lot going for him in that he could lease equipment to his corporation. He would be able to deduct interest for the policy loans. Pretty neat. Depreciating the trucks at the time. He's got a captive customer, of course, in himself who's sure to pay on this lease and on these payments. So there are some ramifications for the folks that are out in the business world. Okay, I do get asked by folks, should I privately own this policy? Should my business, my LLC or whatever, own this policy? Should I put this policy in a trust? At the end of the day, everybody's situation is different. And at the end of the day, choice. Isn't that nice? Again, private ownership. If you want to transfer this property, this asset to a business, you can. If you want to transfer it to a trust, you can. I'm not saying do one way or the other. But when you do privately own assets like these, isn't it beautiful to have the choice? Here was a fresh takeaway for me. On page 58, I was reading where Nash was talking about the additional interest that you pay by giving a market rate to what you're utilizing for financing, right? So here's what struck me new, maybe for the first time, but it certainly struck me as new. He said the additional interest that you're paying via paid up additions, premiums, okay? So the interest is additional premiums that you pay into the paid up additions rider of your policy. That increases the cost basis. And because the cost basis increased to a height that it didn't have to be or wouldn't have been if you hadn't have been using the policy for becoming your own banker, but because the cost basis did increase, you now have a greater amount of capital that you can access via policy withdrawals tax-free, such as when you come to passive income years in life and you want to withdraw up to the cost basis. Well, by using this policy for becoming your own banker, meaning build it for a high cash value from the start, access capital to finance things in life, recapture interest that otherwise would have gone to other people, which means additional premiums, which means the cost basis goes up, which means you have a greater pool of capital to be able to withdraw up to your cost basis. And then you can still do policy loans tax free from there and still render a death benefit. So he lays all that out right here. Again, of course, how you can withdraw tax free up to the cost basis. But it just clicked for me again when I was rereading this section that when you make additional PUA premium payments, you make the cost basis go up. Well, of course you do. I already knew that. But I have not yet personally reached passive income years in life. I'm still very active in what I'm doing in the wide world, being a husband and a father and business and all the different things that I'm doing. And that just hit me fresh. So I appreciate, again, for myself, rereading this book, Becoming Your Own Banker. I systematically try and do it at least once a year. But even in preparing for this particular episode, I've benefited myself. So here's where he sums it up. He says, this gentleman, at the end of building this private banking system, running his business, he can sell his fleet at the end of the day. Okay, when he's ready for passive income, he could be withdrawing up to the cost basis. He could sell his fleet. He could lease. He could establish another business where it's a lot more hands-free, where he's just in the financing of he's renting out his equipment. He's leasing equipment. He could just be, as Nash says, he could just be having fun. He could be doing something in the wide world that's of great value for somebody else who's ready to come into this space and do logging for themselves or whatever it happens to be. Okay? And he could be in a very fun stage because of the freedom, because of the profitability that he experienced through his working lifetime as his own banker. So Nash does add an addendum in this 5th edition, page 63. It's an addendum where he does clarify about dividend scales, the volatility of the markets going up, going down, the interest rates, that's certainly also gone up and gone down. We've been here recently in the 2020s. Okay, we've been in some of the lowest artificially created interest rates that there have been, and then now fast increasing interest rates. We'll see where it goes. Just very interesting. But I'm saying he wrote that addendum back in 2000 or whatever. So those details, are they going to dictate some differences? Yes. Yes. In the results of this process, yes. But not nearly so much as, again, mine and your behavior in implementing this concept. Mine and your behavior are what is going to make the biggest difference in implementing becoming your own banker. And in fact, the main points that he gives us are capitalizing a banking system by using imagination, reason, logic, prophecy. Remember, he told us from the start it was going to be an exercise. To become your own banker, it's going to be an exercise in imagination, reason, logic, and prophecy. These figures are not set in stone, okay? But our behavior, here's the quote. He says, your behavior is the most important factor. And that's on page 63. Your behavior is the most important factor. That should be the tagline for this episode. And I like a little clarification that he gives right here at the end, too, of this section. Some companies are preferable for implementing the infinite banking concept. There are lots of mutual life insurance companies out there. There are lots of those companies that provide whole life insurance. But not all of those companies, and there are several, but not all of those companies are ideal and preferable for implementing the infinite banking concept. And it's good to recognize that. He points that out himself. I appreciate that. I can attest to that myself. There are those that are favorable to infinite banking and those that are not. And then when you couple that with an agent or advisor who has implemented this concept themselves in their own life and can help you in speeding up your learning curve and your implementation, that's so very key. That's so very important. So I hope that you've enjoyed reviewing this section, Equipment Finance, Part 4 of the Becoming Your Own Banker book by R. Nelson Nash. If you'd like to watch a free introductory presentation to the infinite banking concept, I've got that on my website. And then, of course, my calendar, where you could get on my calendar and we could talk about your questions, your goals, your aspirations, what it would look like for you to implement the infinite banking concept into your household or your business or your financing equipment, whatever it is that you're already doing. So this has been a great pleasure for me. You can find me at durhamtalents.com. I look forward to our next conversation. Have a great day. Take care. See, this is why you're supposed to have this written out beforehand. Book review, book review, book review. Let's go. It's all good. It's all good. And you can be in the business of